Hello and welcome to today's Cashflow Planning webinar. We're very excited to have you along today. My name is Carole and I'm a Senior Manager in the Business Advisory team at BDO Wellington. COVID-19 has affected every business in one way or another. These are unprecedented times, so whether you're pivoting your business to capitalise on opportunities or managing your way through some challenges, cash is still king. So understanding and managing cash is critical. This webinar is one in a series we are planning for this year. In June, Doug Haynes and Johnny Wild delivered a business recovery planning webinar, which presented how to develop a plan for the new normal. Today's webinar will help you manage your cash flow in the new normal. Regardless of whether you're on the BRP webinar, you're sure to benefit from attending today. It's not too late to catch the BRP webinar. It's available on YouTube. Feel free to contact us if you would like the link. Today's presenters are Justin Martin and Shelley Hunwick. Both Justin and Shelley are based in our Wellington office. Justin is a partner in our advisory team. Over the past decade, he has worked closely with a range of clients, with a particular focus on the not-for-profit sector and the retail industry. He also heads up our financial literacy colour accounting training in New Zealand. Justin is a past trustee of a local school, and outside work he is a keen runner and more recently dabbles in DIY. Shelley is an associate in our advisory team. She leads a team of accountants working with SMEs on various business advisory assignments and is also such as reporting and cash flow management, and has a special interest in franchises and holiday parks. Shelley also runs the Wellington Zero Masterclasses. She enjoys discovering new places, and as international travel is not on the cards at the moment, she's slowly making her way around New Zealand in her caravan. Great, so before I hand over the reins to Justin and Shelley, just a little bit of webinar housekeeping. This is a Microsoft Teams live webinar and you will be on mute. We have allowed time for Q&A at the end of the presentation, so we welcome all of your questions. To ask a question, simply select the chat icon. A question box will appear, click Ask a Question, and this is where you put your question in. Your questions are only visible to us, so please don't be shy. Great, so let's get into it. Justin, over to you.
Thanks, Carole. It's great to be on the webinar today. Welcome again to all of our attendees on behalf of BDO Wellington. We hope that you find the session today informative and practical. Today, we're talking about cash flow, but taking a step back, if you haven't already prepared one, you need a plan for how your business is going to survive and thrive post-COVID. We have been busy updating plans for our own business, as well as working closely with our clients and presenting webinars and writing articles. At BDO, we believe that the last few months have been a time when demonstrating leadership through action has never been more important.
That's right, Justin, and we've all seen this saying before. So those of you here today, I think, deserve a pat on the back for taking at least one step towards planning for what we're calling the new normal. If you come out of this session with 3 practical actions that you can put in place in your business, that is a huge success. The biggest problem in business is failure to implement. So if you don't write your actions down, you won't remember them. We want you to get maximum value from this session. So if you have any questions as we go, please use the Q&A function, which Carole will monitor and respond to. So as Justin mentioned, having a lot of experience in cash flow management, not just for ourselves, but in helping our clients, we're incredibly familiar with the 5 key principles of keeping the cash flowing. Throughout the session, we'll be repeating these principles in various ways. So number 1, cash is the lifeblood of any business. Without cash, your business cannot survive. What you might see as a very profitable business could fail because of poor cash flow. When a business is growing fast, often in startup mode, it needs working capital to fund that growth. That's why it's called working capital, because that spare capital has to work hard, because the business is having to pay for stock, fund payroll costs and overheads, and buy new assets before it gets to bank the cash for selling its goods or services. The fact that the business is making a profit on paper and yet cash is tight is precisely why every business owner needs to understand their cash flow drivers. These are business processes that affect your cash flow. Processes like how you order stock and pay for it, how you bill for your services, and how you make sure you get paid by your customers, just to name a few. Many of you here today would have been asked to complete a cash flow forecast for the bank, often because your overdraft is blowing out. When that happens, preparing a cash flow forecast is vital. In fact, every business deserves a cash flow forecast. This should be one of the things you do. It's simply best practice in business. And yet, simply preparing a cash flow forecast every time the bank asks for one is not going to fix the underlying causes of poor cash flow. Borrowing more money from the bank is not a long-term solution, and it costs you interest. By looking at the underlying causes of your poor cash flow and making some changes to your processes, you're not just treating the symptoms, you are treating the cause. This won't just help your cash flow, it will build a much better and more valuable business. And not to mention, it will also reduce your frustrations and stress levels enormously.
So here's what we're going to cover in this session. First, we're going to help you understand the difference between profit and cash, because reading your monthly P&L and seeing your bottom line profit is one thing, but understanding why you don't have that profit sitting in your bank account is entirely another. Then we'll look at the working capital cycle so that you understand why working capital is so important for your business, and even more so when your business is growing. We'll then look at the cash conversion cycle, how many days it takes to convert the goods or services you produce into cash. Finally, we'll look at the 7 biggest causes of poor cash flow and consider some ways we can improve business processes so you can shorten your cash conversion cycle. Throughout the session, we'll be reminding you of best practice. That is, that every business needs a cash flow forecast because every business deserves an understanding of cash to enable better decision making. Then it's accountability time, when you have to decide what action you're going to take as a result. We'll keep the session straightforward, to the point, and I hope that we'll have some fun along the way.
All right, here, I have a question for you. And as this is a webinar, I know I'm not going to get a response, but please just have a think about it. Do you read your financial statements from your accountant? Be honest with yourself now. It's okay if you don't read them, because we know it's often the case. Okay, so now think about this one. Do you understand the difference between profit and cash? If the answer is something along the lines of not really, when you really think about it, that's not surprising. It takes a bit to get your head around the difference between the two. Profit is the money left once expenses are paid. Some people think business owners can take profit to the bank. If only. Profit is used to pay for any new equipment or materials needed for the business to grow. And unless you buy a politician or two, you pay taxes out of profits as well. Only after paying for growth and taxes do owners get to take the money home. Here we have the actual definitions of profit and cash. Profit is the total sales value, less the cost of sales and other expenses, and it excludes GST. Cash is all cash inflows, less all cash outflows, and includes GST. So on screen, we have a table of various items that would be considered either a cash or profit movement or both. So let's go through them. GST. This isn't trading income or an expense, but it certainly is a cash movement. And there are plenty of businesses out there who still get a surprise when it comes to GST time when they shouldn't. Next up, loan repayments. These reduce a liability. They aren't an expense incurred in trading, but cash does leave your bank. In relation to this is interest on loans. So this is a cost of having a loan and therefore is both an expense you deduct from profit and a movement of cash out of your bank. Cash that you spent on assets. So assets are items that are used over and over again in order to grow your business. They aren't a one-off cost that you can deduct from income, but you do pay cash for them. Cash received from the sale of fixed assets. Obviously when you sell an asset you get cash for it. However, this is not as a trading sale. When you sell a fixed asset, it just reduces your total assets. So think of any fixed assets you may have, say a motor vehicle that you hardly use. If you sell this, then it will be like an instant cash injection. And lastly, depreciation. This is calculated to give you a tax deduction on the wear and tear of an asset. It's an anticipation of the fact that it'll be worth less when you eventually go to sell it. So it's not a real cash outflow though, it's just a calculation for tax that reduces your profit. What the calculation of profit does not show is how much of that profit needs to be retained in order for the business to grow. In other words, how much to invest in more stock, materials, labour or personnel, plant and equipment. Available cash, on the other hand, is affected by how long our customers take to pay us, how long it takes us to pay our suppliers, whether we are growing as a business, what we are drawing out of the business in personal spending, our loan repayments, our income tax payments, and the new assets we need to buy, for example, a new motor vehicle, from time to time. So the link between profit and cash is simply timing, and we call this the working capital cycle. Justin, would you mind please taking everyone through this in some more detail?
Sure, so let's look at the working capital cycle. For example, if you're a service provider, your working capital cycle is this. You sell services to a customer. Once you've invoiced your customer, that amount increases your accounts receivable total. That is what your customers owe you. But that money isn't in the bank yet. It's sitting in your accounts receivable ledger until you get paid. And that's the cycle. If you're a retailer or manufacturer, the cycle works like this. To make your goods, you purchase stock and materials. You may have to pay some suppliers immediately. Others may allow you to pay on the 20th of the following month. You manufacture your goods, and at any point in time, you'll carry work in progress or stock of unfinished goods. Once you receive an order for goods from a customer, you make a sale. You invoice that customer, and the amount of that invoice is now in your accounts receivable ledger. You now have to wait for your customer to pay you. If you're a not-for-profit, your cash conversion cycle might look quite different to either of these examples. So do let us know if you're in this sector, and we would be happy to discuss with you after the presentation. So you can see that it takes some time, depending on your type of business and industry, to convert whatever it is you make or whatever service you provide into cash. To understand the cash flow effect of this on your business, you need to calculate your own cash conversion cycle. Let me show you what I mean by that. Let's take a look at a real but simple example using a wholesaler of goods. The wholesaler buys stock from suppliers and has until the 20th of the following month to pay for that stock, which is an average of 35 days. So on average, they must pay their suppliers 35 days after buying the stock. They aren't able to sell the stock the moment it comes into the warehouse. Some stock sells quickly, other stock takes longer, and eventually some stock has to be discounted to get it to move at all. On average, they hold on to stock for 65 days from date of purchase. When they sell the stock, they provide credit terms to their customers, but a number of customers are not observing those credit terms. So on average, it takes 45 days for customers to pay. Now we can calculate this business's cash conversion cycle. 65 days average stock holding, plus 45 days to get paid by customers, less 35 days credit provided by suppliers, equals 75 days to convert inputs to cash. Hopefully it's now obvious to you that the shorter the cash conversion cycle, the better the liquidity or cash room to move in your business. If you're a manufacturer, wholesaler, or retailer, to calculate your cycle, you'll need to know three key metrics: average supplier payment terms in days, average stock holding in days, and average debtor days. If you're a service provider, to calculate your cycle, you'll also need to know three key metrics: average supplier payment terms in days, average work in progress days, and average debtor days. And BDO can assist you with calculating these metrics.
Okay, so let's say you've calculated your cash conversion days. What's the impact on actual cash in the bank if we work to shorten the cycle? The impact on cash flow of shortening your cash cycle can be incredible. Let's look at a worked example along the same lines as what Justin explained before with a simple manufacturing business. Here we have an example of a manufacturer, initially with a cash conversion cycle of 75 days. By focusing on reducing debtor days by 9 and inventory days by just 6, the business has released more than $52,000 of cash. That's $52,000 off the overdraft, $52,000 in the bank, however you want to look at it. These are the sorts of numbers that we can help run through with you to see the impact on your business or organisation with shortening your cash cycle. However, you can't just release this cash without firstly doing something differently. So to achieve this sort of cash flow improvement, you need to have a plan.
So looking now at cash flow improvement, here are the 4 actions you need to take to improve cash flow. Prepare a cash flow forecast and make this part of your annual business planning. If you already prepare a month-by-month forecast every year, well done. This is what our most successful clients do. If you find the thought of doing a cash flow forecast scary, that's okay. The first time you prepare one, it can be confronting. You're talking about money, facing cash flow challenges. That's important. They won't go away. When you have your forecast in place, however, there's a real sense of peace and relief that comes with that. You can share your cash flow forecast with the bank to help build better communication and a stronger relationship. You'll be able to predict those months where there is more cash going out than coming in, for example, when it's tax time. You'll also know in advance about any seasonal fluctuations in your business. You won't be flying blind anymore on the issue of cash flow. Secondly, many of you are using Xero. Whatever your accounting or reporting software, your forecast needs to be incorporated into or built into that software so you can report actual results against forecast every month. This enables you to recognise where you are against your target. You'll learn how to become aware and comfortable with your cash flow cycles and where you can improve them. Having a cash flow forecast in place is one thing, but using that knowledge to change how your cash flows is another. To do that, you have to understand your cash conversion cycle and improve the business processes that can shorten it. And you have to set some SMART goals. Having someone to encourage, support, and even have tough conversations with you as you work on your business is the fastest and easiest way to get ahead. That person should be independent, not a spouse or a friend. If you don't already have a business coach, this is something that BDO can help you with.
Thanks, Justin. The plan put like that is pretty simple and is tried and true. A recent example of that exact plan comes from a client of mine. They needed some short-term visibility coming out of lockdown, specifically to see how they needed to trade in order to be able to pay tax and GST without breaching their overdraft limit. So we did a 12-week cash flow forecast, just a very simple one, based on what was in the bank on day dot, and we stretched it out to the end of August. We've been helping them through this each week by looking at the forecast versus their actual figures to keep them on track. Because they use a system like Xero, it's meant that the whole process has been seamless. We can get the figures we need when we need them and show our client how they interact with their cash balance in order to meet these goals of being able to pay tax without breaching their limits. This is an example of a simple short-term forecast and is one of many examples we have in working with our clients on what suits them, whether it's short-term or long-term, and how we can keep them accountable. I personally think one of the best outcomes of these is creating visibility coupled with peace of mind for the business owner or manager, especially in these times. So to help you understand your cash flow better and to figure out why things may not look as rosy as they could, you should have a good understanding of the key causes of poor cash flow. These causes will make you think about your numbers and processes differently, and in turn, what you can change to make a positive impact on that all-important working capital cycle. While there are many causes of poor cash flow, here are the top 7 on screen. So firstly, a poor accounts receivable process. This can result in debtor days, being the time between billing and banking, being too high and stifling your cash flow. On the other side of that is your accounts payable process. A review of all your supplier terms may identify ways to improve cash flow or just get better terms of trade. Thirdly, the inventory process. Carrying stock for too long means full shelves but an empty bank account. This is no different if you're a service provider with work in progress that is yet to be billed. Number 4 on the list is a goodie. So maybe your debt and capital structure needs to be reviewed. Perhaps your debt should be consolidated and paid off over a long term. Or maybe you need to have an honest look at your drawings from the business, or the business needs an injection of capital to fund its growth. Often significant cash flow improvements can be achieved with a regular review of existing debt. Overheads. So every business should do a thorough review of its overheads every year. This is easily overlooked. Number 6 is gross profit margins being too low. So low gross profit margins is another way of saying that your variable costs are too high. There are a large number of strategies that you can implement to improve margins. Lastly is in relation to sales levels just being too low to support overheads and other cash demands on the business. This comes down to how viable the business is right now. If the business is in high growth mode and sales are increasing rapidly, then the business needs finance to support that growth, and you need to review a financing plan. If the business isn't in growth mode, you need to focus on how to grow sales. So we're now going to go through each of these in a bit more detail and provide some practical tips on what you can do. Please feel free to write notes, and also in the Q&A section, please type in your email address if you'd like us to email you through a brief summary of each. Please be aware that only we will be able to see your email address when you do this. Right, Justin, let's delve into it.
Thanks, Shelley. Okay, so what are some ways that we can shorten our cash conversion cycle by getting paid faster by our customers? Well, here's a few ideas. Billing faster, on completion and with interim billing. As an example, I've recently had some work done on my property, and as I was preparing for this webinar, I realised that this particular tradesperson invoiced the day after they completed the work, rather than waiting until the end of the month. A good example of billing faster. Offering your customers easy payment alternatives, such as zero online invoicing, credit card, or direct debit. And think about implementing a zero add-on that chases money owing for you. You could check out debtordaddy.com or chaserhq.com. What are some of the ways that we can improve our accounts payable processes? This is where we owe money to suppliers. Well, have a think about reviewing all supplier agreements, looking carefully at payment terms, prompt payment discounts, and delivery charges. Review your payments process. Do you make multiple ad hoc payments throughout the month, or do you have one or two dedicated accounts payable runs? And are you using batch payment functions to be as efficient as possible? Lastly, really important to make sure that you've got spending budgets in place and that your staff and managers know what their spending budgets are and work to those budgets. And as an example, in our own business here at BDO, I've had a staff member responsible for our team entertainment budget who has just recently sent me a mid-year report to let me know on actual spend against budget year to date. A great example of a staff member knowing what their budget is and taking accountability for it.
Now, I realise this won't be applicable to all of you, but very important to go through it either way. So what are some of the ways we can shorten our cash cycle by moving stock or work in progress faster? So at a very high level, think about your stock control process. Having a strategy and documenting this and communicating to the team is so important. Also review your stock ordering systems. Are they inefficient? Do you have visibility on this in order to identify issues? When it comes to work in progress, you need to be able to capture time. The faster and easier it is for your team members, the better. It should also be linked with scope to ensure time isn't spent on work that customers won't expect to pay for. Using technology to better manage stock reordering and slow moving stock is another point. So good technologies like outsourcing. We have experts around the BDO network on various inventory software that can save you time and effort by optimizing your stock holding. This is probably the most important point. Slow moving stock policy, do you even have one? And shrinkage controls. This happens, but do you have checks and balances in place to curtail this? Right, if you're asking yourself things like, we don't know what business funding options we can manage in order to survive at the moment, then please pay particular attention on this one. You'll need good debt structure in order to bring in more funds if you need to. Okay, so how can we improve our debt structure? If you have an existing business loan, be sure to review interest rates, particularly at the moment, and consider fixed versus variable options. Also review the term of the loan. Is it right for the business or organisation? Review your owner drawings and don't avoid this discussion. If you're taking more than the business is able to keep up with, you will drain it of its working capital. so meaning the business will no longer be able to work for you on its own. Consider revising your personal budget, and realistically for the current times, please. Consider new investment by owners or from new sources. And finally, check your return on investment on the fixed assets. Are they actually working well to generate income for the business, or do they need to be sold, which will free up cash?
How can we reduce our overheads? And are we getting value and return from the overheads we currently incur? Reviewing at least annually and getting visibility over where your spending is going. This is exactly what we do with our clients when we meet to discuss the year in review. Having someone independent like your accountant going through your expenditure with you can be a great way to challenge yourself on the necessity and value of each line item. Can you negotiate a better deal with suppliers? Think about IT, server costs, phones, website, insurances, power, and recruitment fees. Go digital. Are there any services that you can engage remote or virtual providers for to save on cost while still receiving a sufficient level of quality service? Our gross profit margin is what is left from sales value after deducting variable costs such as stock for resale, materials and labour. So how might you improve a low margin? Reduce rework, wastage and errors. All of these contribute to higher costs to make a sale, reducing your gross margin. Improve systems and efficiency. Having visibility via good systems and getting regular reporting by job or client is key to understanding gross profit margin at a granular level and being able to take action. We help our clients to carry out this analysis using their financial data, and we often find that they are generating significant sales volumes from a few key customers that may be making very little gross margin on these sales. Understanding this can help us then work together to implement strategies to improve the margin with those customers, or perhaps rethink which segments of the market we should be focused on.
All right, number 7, sales levels too low. So some examples of what you can do to improve sales levels are increasing your customer retention rates, generating more leads, increasing your conversion rates, increasing transaction frequency or value. However, there are literally hundreds of ways to increase sales. It would be much more effective if we go through the relevant ways for you one-on-one as part of our cashflow management coaching service, as it depends on your business or organisation. As mentioned earlier, these are the top 7 causes of poor cash flow. There may be other causes which we can uncover with you. So how can we help you specifically? There are 2 options here. So firstly, we can prepare a cash flow forecast for you with a 1-hour review meeting to discuss it. The process of preparing a cash flow forecast is quite involved, and the 1-hour meeting will give you a chance to step back with us and really understand its meaning and where you can take action. The second option is for us to take you through our cash flow management coaching program. This option will mean that you will not only have a cash flow forecast prepared by us for your business, but also quarterly review sessions over the next 12 months. These sessions will include looking at what has actually happened compared to the forecast and ensures accountability to see you through your cash flow plan for the year.
Hey Shelley, this is a great time to plug our friends at Wellington NZ. The government have recently tipped another $40 million into the Business Advice Fund, and Wellington NZ are our local agency managing the allocation of this fund. So depending on certain criteria and how you're affected, you might be able for some of this funding. Anyone on the webinar who's keen to talk to Wellington NZ, perhaps get in touch with us and we can chat through whether or not you might be eligible and let you know how to register with them.
Awesome, thanks Carole.
Right, we're nearly at the end of the presentation now, so please do take a few moments to identify the 3 most important actions that you will take from today's presentation. If one of those actions you have identified is that you would like some assistance with preparing a cash flow forecast and being held accountable to your goals, please contact your usual BDO advisor or send us a message in the Q&A with your contact details and we will be in touch.
Great, thanks guys, that's awesome. It's really important to understand your cash conversion cycle and to know the difference between cash and profit. And the common drains on cash is actually very thought-provoking, and I'm sure you've generated a lot of attention on that today. Cash flow forecasting is really important right now, and in some circumstances it might just mean you get that peace of mind that you're going to be okay. We've recently had a really good example of that with one of our clients. This client operates a business that was closed during the lockdown, and they were losing sleep worrying about the dip in cash and how it was going to impact them for the rest of the year. So they asked us to look at their forecast, which of course we did, and we were able to help them see that now they are back up and running, the worst of the storm had passed. They did have to dip into their savings to cover some overheads while they were closed, but things are looking really healthy now for the rest of the year. We were able to look at their drains on cash, and they'd actually already made some changes to free up extra cash, and our forecast helped them to decide to delay a capital project that they had planned until next year, just to be safe. It was actually really rewarding to help them understand their position and to give them peace of mind. All right, question time. So we've got a couple of questions. I'm just working through them while I'm talking, so bear with me. First one, Justin, I will direct this one to you. It sounds like a forecast would be a great idea. However, I really don't know where to start in preparing a cash flow. What do you recommend as the best starting point?
Thanks, Carole. Great question. First and foremost, make sure that your financial data is up to date. If you already have a business continuity plan in place, then that's a really great starting point as well. And you're most welcome to organise to meet with us to go through your goals and estimates for the year ahead.
Great, cool. So another question here. Once I've completed a forecast, can I update it during the year as things changed, or do I need to start again? I guess it's quite daunting because it sounds like a very expensive process if that's the case. Maybe Shelley, you can answer this one.
Yeah, I mean, the answer is absolutely you can change it during the year. I guess the ease of doing so really depends on what you've used to prepare your forecast to begin with. Sometimes it could be almost like doing it from start to finish again if you've just got it all written down, or even Excel can take a bit of time if you don't have the right formulas to carry updates through. So, but yeah, the short answer is yes, you can change it.
Yep, and that actually leads nicely onto the next question here, because you mentioned about Excel and how that can create more time sometimes. We have a question asking what software or tools would BDO recommend for cash flow forecasting?
Yep, so I can answer that as well. So yes, I mean, while Excel is very reliable, we would actually really recommend using tools that feed from your live financial data. So if you use an accounting system like Xero, it's in the cloud, there are a few apps and add-ons that connect to Xero and automatically pull your information to prepare a forecast. And you can subsequently update this and also compare against actual results to date. So we actually have a lot of experience using apps and add-ons that do this, such as Spotlight and Futurely. BDO's discounts on apps and add-ons like these, you can have access to them for as little as $20 a month. So yeah, very cost effective. And the key benefit is that they are in the cloud, so you'll be working with your BDO advisor on the same numbers.
Great, cool. Another question. We are already partway through the 2021 financial year. Is it too late to prepare a forecast? Justin, this one for you.
Not at all. A forecast can be prepared at any time, and if you don't already have one in place, as we've outlined in the presentation today, now it really is critical. We'll work with you to determine whether it's best to prepare an 8-month or a rolling 12-month forecast.
Great, fantastic. One final question. We have a question about what would you do cash flow wise if you had to deal with Australian and New Zealand dollars and to reduce your FX losses. Now, I tell you what, if I knew and I had a crystal ball, I would love to be able to answer that for you, but I guess the best thing that I would recommend is to work with your bank. Banks have got some fantastic tools in there and they are experts in that area, more so than me, and they'll be able to help you potentially to lock in good exchange rates if you've got any big purchases coming up. So I guess the best advice there is just to partner with your bank, who you're probably working with very closely at the moment anyway, so good luck with that. Great, so no other questions? Nope, that's great. Thank you very much for your questions, they were fantastic. So I guess it's time to wrap this up. Thank you everyone for attending. A link to this webinar will be emailed to you all tomorrow, and we would love it if you would share this with anyone else that you think might benefit from having a listen. As Justin said, make sure you think about your next steps and keep in touch with us here at BDO. Thank you.
Thank you.